everybody who's attending. My name is Richard Silberstein of Silberstein Insurance Group, and today we have our monthly webinar series with Stacy Barrow from Proskauer, where we're going to give everybody an update on healthcare reform, a topic that everybody is just loving right now at this time of the year. And we're also going to review in a condensed version of the slides that we had at the SIG seminar. We also have a series of questions that have come in from many of our clients that we're going to address throughout the webinar to bring everybody up to speed. If anybody has any questions during this presentation, feel free to email me, richard@silbs.com, with any questions, or feel free to text me for those that want to at 443-250-8606, and we'll be able to address all of your concerns. So that's richard@silbs.com, and that's 443-250-8606. So we have a lot of information to cover. I'm not sure where to get through all of it because we want you to see sort of what we covered at the SIG seminar, and you'll see later on in the slide deck that there are instructions to go to our SIG website and put in a code, and you can get an electronic version of all the attachments from the seminar. So the first thing that we'll go over is the ACA review and the pay or play. And I guess, Stacy, one of the things that we want to cover is some people are a little bit confused about the pay or play in terms of what is delayed and what's not delayed, so we sort of just want to touch base on that. So I'll turn it over to Stacy to comment on some of the slides as we go through them.
Sure. Thanks, Richard. And this is Stacy Barrow from Proskauer. So just to kind of clear up any questions on the delay. So the delay really only affects the employer mandate. There are other aspects of healthcare reform that have been delayed, but this particular July 2nd announcement pertained only to the player pay mandate, and the entire mandate is delayed. So the need to start offering benefits to employees who work 30 hours a week, if you're a large employer, that's been delayed until 2015. So if you wanted to keep eligibility, say 40 hours a week through 2014, that would be permissible, although just be aware that in 2015, you will need to start offering coverage to employees who work 30 hours a week on average. So if you need to realign your workforce, make some changes, you probably want to start doing that earlier in the year, earlier in 2014, so that when you look back over 2014, you'll be able to limit your employees' hours as need be.
Okay. So so Stacy, on the next slide, one of the things that that was mentioned was the IRS has suggested that employers might voluntarily comply during the 2014 plan year. Bottom line is that people really don't have to follow a lot of the things that they were concerned about to prevent them from paying a $3,000 penalty or $2,000 penalty in 2014. Is that?
Yeah, that's right. The IRS suggested in their guidance on the delay that employers can voluntarily comply in 2014. Obviously, I think the IRS would be happy if employers complied with the employer mandate. I think that they were talking about the reporting requirements when they were saying you can voluntarily comply in 2014. Once we have guidance on those reporting requirements, the IRS is encouraging everybody to get their systems in line as soon as possible, and to that end, they're encouraging voluntary participation in 2014.
Okay, and so what is not delayed is everything else, right? So the next slide pretty much basically says everything else under healthcare reform, including the individual mandate, the exchanges, everything else. Is that correct from your standpoint?
Yeah, at least with regard to that specific delay. I mean, as we know, the exchanges have suffered a couple of delays on their own, unrelated to this, this particular guidance that came out over the 4th of July. But as we saw on October 1st, some of the exchanges, particularly the federal shop exchanges, I believe, are delayed a month. So there are little aspects that have been pushed off a bit as well.
Okay, good. So let's get into some of the specifics. Many of people know about many of these different provisions, but we just want to reiterate that summary of benefits and coverage and 60-day advance notice of material modifications, notice of exchange coverage, which we'll talk about in another section coming up. 90-day limit on waiting periods. So again, Stacy, if somebody has a waiting period that's 180 days and even though there's a delay in the mandate, they still need to change their waiting period for 2014?
That's right. The waiting period rules, although we kind of think of them as linked to the employer mandate, they are actually a separate requirement, and they apply to all employers, and they do start, or they are effective starting with the 2014 plan year.
And for those on the phone, many carriers, if you're fully insured, I know Aetna has come out with some communication, I think on their small group product, that basically says they're going to automatically be changing some of the waiting periods if they know that that they are not compliant. Please be sure to talk to your SIG representative, because some people might say, I'll do it first of the month following 60 days of employment, but if a month has 31 days in it, you can end up having more than 90 days before benefits kick in. Stacy, the reporting of the value of employer-sponsored coverage on W-2s, again, that's for employers that are more than 250, that have more than 250 W-2s. One of the things I just want to sort of touch base on, because a lot of employees are, sort of why is that going on? Is there some discussion that is the HHS is now capturing all that data so that at some point if they wanted to make benefits taxable, they would have that data? It's sort of like, why are they collecting that data?
That's a good question. I mean, the stated reason, in particular for that W-2 information, is actually it is supposed to be informational for employees. I know that might seem far-fetched, but that is the stated reason. I know I've heard others mention that perhaps this is a prelude to getting rid of the tax preference for group health insurance. I tend to not agree with that. I think there's always going to be some tax preference for health insurance. So I haven't seen anything officially or unofficially from the IRS that would indicate that part of the reason they're doing this is ultimately to start taxing the benefits.
Right.
Least,
and if that was the intent at some point, I'm sure they wouldn't be politically out there saying that now. Medicare payroll tax, that's been out there. FSA contributions, we've dealt with all of our clients on making sure they're compliant there. So we get into the PCORI fee and the health insurance industry tax and the transitional reinsurance fee. And again, if somebody's fully insured, that's automatically built into the premiums. And so that's why January 1, a lot of carriers are allowing companies to renew early because they know the rates are going up January 1 on the fully insured plans. On the self-funded plans, that is really paid for by the self-funded plan or by that employer, correct?
Yes.
Okay. Now, one thing that came up I wanted to get your opinion on is, especially for our self-funded employers that are on the phone, we have a lot of sharp HR people that are always looking into especially at the SHRM website, and it came up that the PCORI fee can't be paid out of plan assets. And so could you, for those that are on the phone that are self-funded, I mean, I sort of feel it's like 6 half dozen, one or the other, because I'm going to be increasing employee deductions. A lot of our clients are basically saying, I'm going to pass on those fees to my employees. I'm just raising their employee deductions. Have you had any conversation on that as to what you can and can't do or how you can pay for that?
Sure. So as you mentioned, that PCORI fee, the way that it is designed is that with respect to self-insured plans, it's on the plan sponsor. It's not on the plan itself. And so the DOL indicated that this is really a tax on employers, and you shouldn't use plan assets, shouldn't have employee contributions attributable to the PCORI fee. Now, like you said, it's kind of 6 of one, half dozen of the other. If the employer wanted to pass that fee through, they could simply adjust their premium contribution down by $1. and that would, obviously kind of transfer the liability over to the employee. It's not something that you could simply pass through, though, kind of maintaining your stated contribution limit. So, for example, to maintain grandfathered status, you can't change your contribution rate by more than 5% based on the rate that was in effect in 2010. So say you've already used that full 5%, and now you want to pass through the PCORI fee. The only way you could do that is further adjusting your premium contribution as an employer, and that would be 5-point-something now because you'd be over that 5%, and that could trigger a loss of grandfathered status. That's really the only impact I can think of in that very unique situation where it would actually have a tangible effect if you were to adjust your contribution rate to pass through the PCORI fee. But some employers like to say, we pay 85% of the rate. If they were to pass through the PCORI fee by reducing their contribution rate, maybe they could only say we pay 84% of the rate, or it might not even make a full point difference, frankly.
Right. And we're having more and more of our self-funded clients that have to pay it directly. Basically, you're saying is, we want to make sure that we're building in our employee contributions where whatever increased taxes and fees that we're having the employee, we have clients that are basically saying, what's that, out of is it, $3 per pay per individual, $9 per family, and that's sort of the base that we're going to start it with as we look at employee deductions. So it's been interesting where that fee is really being passed on to a lot of employees, unfortunately. The other thing is on the transitional reinsurance fee, they came out and they stated it's going to be $5.25 per member or per belly button on the plan. And again, if you're fully insured, it's built into the rate. If you're self-funded, you have to pay that. As Peter said at our seminar, and I want to make sure people on the phone that didn't attend our seminar know, is that's an estimated that is an estimated cost. That could be higher or lower depending on who goes in the exchange and how that works. Do you mind touch base on that?
Yeah, that's right. I mean that fee, the number you quoted, $5.25 per member per month, it is not statutorily driven, meaning it's not baked into the law. That number is an estimate, and even though HHS kind of indicated this is what it's going to be in 2014, that is still subject to adjustment. And we've heard from some actuarial firms that their estimate is a little higher than HHS's even. So that $5.25 number could change. I've heard from the government, this is a temporary fee. This is 2014, 2015, and 2016. It's based on the calendar year, regardless of your plan year. And I have seen a government estimate that said they think the transitional reinsurance fee will decrease from what it is in 2014 through 2015 and 2016. But obviously there's been nothing official, and that's just their thoughts earlier this year.
And for folks on the phone and that are listening to the recording of this, I think that it's important to remember that a lot of people say, what is this fee? And basically, the states needed many of the carriers to participate in the exchanges, and they knew that there's going to be a certain amount of guaranteed issue and attract maybe initially some of the not great risk. And so this money is basically being collected and then redistributed to the carriers based on their volume in terms of in each of the exchange. I saw some number like $8 billion is going to be collected. It'll be redistributed amongst the different carriers that are participating on the exchange based on their amount of enrollment. Is that accurate, or do you want to clarify that? Or
I'm not 100% sure how it gets dispersed, but I know it's basically to offset the possibility of adverse selection, and it's probably a pretty good possibility if the national experience is like what we saw in Massachusetts when we first had our exchanges. We did see pretty severe adverse selection.
Right. And so what I had read in this article was that if a carrier has a lot of business in a certain state, sort of like by state, by the amount of enrollment they have, they could get a larger share of that. And if an employer is not if a carrier is not participating on the exchange or not having much enrollment, then they will not get as much of that. So,
yeah,
okay,
that makes sense.
So wellness incentives, we'll cover that in a little bit from that standpoint. The individual mandate is not delayed. Again, we'll cover that in a little bit. And then an employee who is eligible to enroll in a non-calendar year plan that begins in 2013 and ends in 2014 will not be subject to a penalty through the month in which that plan year ends.
Yeah, let me just say that in English, because I know that's our slide, and I know it doesn't read that friendly. So what the crux of this is saying is that if you have a husband and wife, and say the husband's employer plan has a January 1st plan year, the wife's employer's plan has a July 1st plan year, both the husband and the wife can wait until that July 1st plan year to enroll in coverage July 1st, 2014, and they won't face any penalty under the individual mandate for the first 6 months of the year as long as they enroll July 1st for that non-calendar year plan.
And while we're on this slide, one of the questions that came up from a client that we can just sort of touch base on now is if I'm in the middle of my plan year and the exchange is open January 1, and I'm paying for family coverage pre-tax, and now the exchange is open, is that a qualifying event, or can I enroll my family in the exchange? And I think, as we have discussed before, it really depends. And so could you sort of just clarify that for the folks that are listening to this?
Sure. So in general, I'll talk about the transition relief for the first year in a minute, but in general, when you're in the middle of a plan year and you're as an employee and you're contributing pre-tax for the cost of your health insurance, just because it happens to be open enrollment in the exchange, the availability of an exchange plan is not a change in status event. It's not like when you get married or have a child or your spouse has a change in employment status. It's not one of those events under Section 125 that would permit you to drop your employer's plan and then enroll in the exchange. So that's kind of the general rule. There is a little bit of transition relief for the first year, and it's for employers that have non-calendar year cafeteria plans. And the reason for this relief is before they came out with the guidance on this slide that we're looking at, the IRS felt that because the individual mandate was going to be effective 1/1 of 2014, employees who maybe were eligible for a non-calendar year plan, perhaps it started July 1st of 2013, they might not enroll back in July of 2013, but they would want to enroll on 1/1/2014 to avoid the mandate. Now, I know we have this transition relief here, but this other guidance came out before the individual transition relief. And what it says is, if you are a large employer, meaning if you have 50 or more full-time equivalent employees, then if you want, and it's permissive, it's not mandatory, but if you wanted to, you could amend your cafeteria plan and allow your employees basically one free change in status event between 2013 and 2014, meaning they could enroll in your plan or drop your plan once per year or once during the 2013 plan year without the need to have a change in status event. So, for example, if you, as an employee, you didn't want to enroll in your employer's plan on July 1st, 2013, which is their open enrollment, and then 1/1 rolls around, and the employer, if they wanted to, could permit the employee to make a change to that pre-tax election, elect coverage under the plan, and then the employee would have coverage effective 1/1/2014. And on the flip side of that, they can make the same change going the other way. If an employee wanted to drop, say he enrolled in July of 2013, and then when open enrollment for the exchanges came around, he could drop the employer's plan for a 1/1 effective date and exchange coverage. I think I think both of those situations are going to be fairly limited, especially given the transition relief here for the individual mandate. But one of the nuances to this rule is you're allowed to wait and amend the cafeteria plan retroactively. So as an employer, if you just wanted to wait and see, am I going to have a lot of employees requesting to come onto the plan mid-year, then if you'd like, you can permit them to do so, and you can amend the plan by the end of 2014. So you can kind of do it retroactively. It's a nice little bit of relief, and you can kind of take a wait-and-see approach.
And so that's a good point, because right now you're hearing about how not as functional, or the glitches that we're having with the exchanges. So once those get worked out, if clients would like to amend their cafeteria plan to allow employees to disenroll from their plan and go to the exchange, especially those that don't fund a lot of the dependent cost, that they can do that. And so your SIG representative will be working with each of the people that are listening to this and our clients to review their options as to what makes sense. Okay, well, let's go on to the two things that are still delayed. I think the auto-enrollment is really for the larger employers, and then I think a big thing that I think is coming, because we have a lot of clients that do discriminate in terms of how they might fund people that are salary versus hourly or executives. So could you just talk about what each of these items is, and is there any discussion as to when we might hear further on them?
Sure. As you described, the auto-enrollment is pretty straightforward. It is what it sounds like. I believe this one is only for larger employers, and for that purpose, it's 200 or more employees. This one, there is no effective date yet. The DOL is still putting together its guidance on this. They have told us that the auto-enrollment will be delayed at least through 2014, so we will not have to worry about it in 2014, and based on that statement from the DOL, it sounds to me like they're looking at a 2015 effective date for auto-enrollment, and it's going to be pretty similar to how it works for your 401k plans if you've adopted that auto-enrollment feature. You could adopt it now, and plenty of employers have an automatic enrollment feature where if you don't elect coverage when you're first eligible, you're just defaulted into the base plan, like the HMO plan or something. But under the auto-enrollment provisions, you basically automatically enroll new full-time employees and permit them an opportunity to opt out.
And Stacy,
sure.
And Stacy, we're seeing a lot of companies, because of the surcharges on wellness and the issue of 9.5%, not having anybody pay more than 9.5% of W-2, and also, for other reasons, adding a sort of a bronze type of plan, sort of a catastrophic plan that if somebody is not compliant, you're going to get defaulted into that. There's also discussion that you'd want maybe a lesser plan, so you could auto-enroll somebody into sort of the lower option, lower cost plan, as opposed to enroll them in a rich plan. Is that correct? You
yeah,
choose the plan you enroll them in?
Yeah, that would certainly make sense.
So that's something that maybe for 2014 employers might be thinking about in 2015, especially for our clients that are larger, above 200 lives. So the next one is on the non-discrimination testing, because we do have a lot of folks that are on the phone that we have as clients that have maybe small groups, a law firm that covers partners one way, staff another way, executives versus hourly. Could you talk about what you're hearing or is coming up in terms of non-discrimination testing, and maybe just take a step back as to what do you think the law, I guess in a few cents or less, what is the non-discrimination testing going to mean to employers?
Sure. So just to kind of level set, and you described it pretty well. It's a rule that basically prohibits discrimination by employers in favor of highly compensated employees with regard to who is eligible for the plan and the benefits offered under the plan, which would include things like premium contributions and waiting periods. Those of you that are self-insured are already subject to these rules with respect to your self-insured group health plans. These rules were originally going to be effective back in as early as 2010, actually, And when the Republicans took control of the House back in 2010, one of the first things they did was to make sure that they registered their displeasure with this requirement with the regulators, and they were actually instrumental in getting this particular provision delayed. So it has been delayed indefinitely pending further guidance. And I know we heard earlier in January of this year that we should expect some guidance on these non-discrimination rules by the end of 2013. So that is approaching. I haven't heard anything more on that. I'm not sure when we're going to get guidance on this. I kind of remain hopeful that we may never see rules on these non-discrimination requirements for fully insured plans, because the way the rules are written for self-insured plans, they really don't lend themselves well to the fully insured environment. And of course, there were reasons why, when Congress originally passed the non-discrimination rules, why they made them apply only to self-insured plans. They felt there wasn't as much room for abuse under fully insured plans. So I'm still holding out a little bit of hope that we won't have these rules for fully insured plans, because they're very burdensome.
And is there like a $100 a day penalty on the employees that are affected on this? Is that what that was originally in there?
When you're self-insured, the penalty is relatively modest. You're taxing the executive on the value of the discriminatory benefit, which makes sense. You're just taking away the tax preference the executive would normally get if he was offered the same benefits as everybody else. When you're fully insured, like Richard said, they have a bit of a different penalty structure. And the penalty structure for a discriminatory fully insured plan, at least according to the statute, according to the way Obamacare was drafted, it would be a $100 per day penalty per affected employee. So if you had 100 employees and you offered a management plan to 10 of them, your affected employees would be the 90 folks that aren't offered coverage. So it can really be a very substantial penalty. It appears that it's capped at $500,000 per plan year, but we'll still need to wait and see how the rules are actually drafted.
And that would be $500,000 non-deductible.
Yeah, probably. I think so.
I mean, so we'll see what happens. Okay, let's move on to a couple other things as we get into the new rules for 2014. I think we've covered these with a lot of our clients already, but it's worth noting again that you could have a premium differential up to now 30% from a wellness standpoint, but again, you still have that 9.5%. You can't have somebody paying more than 9.5% of W-2, as you look forward from that standpoint. And again, when we look at that, Stacy, is that really, and that 9.5%, you're really focused on that in 2015 in a sense, because in 2014 you're not paying a penalty?
Yeah, I mean that's you're saying that you don't have to really worry about the affordability in 2014, essentially.
Right. People don't have to. We've had all these clients that are so focused on changing their deductions and getting to the 9.5%, and then the law got postponed, and those people are still focused on that. We have other people that were going to be focused on making sure the deductions were not more than 9.5% of W-2, but because of the penalties got pushed to 2015, that 9.5% does not apply in 2014.
That's right.
Right. And then to tobacco is now increased to 50%, and that does not apply to the 9.5%. And as we'll talk about later in the slide, UPS has come out and basically said they're charging everybody $150 per employee or husband-wife for that. Stacy, of a lot of your clients, because you work with a lot of large self-funded employers and a lot of employers in general, do you see a lot more people doing the tobacco surcharge?
Yes, but not necessarily the 50% level. It's usually a component of nearly every wellness program, but a lot of employers are still kind of in the infancy stages of rolling out these wellness programs. They may not have had them in place for years and years, and so we do kind of tend to recommend, not going from 0 to 60 in 2 seconds, and kind of have a gradual rolling out over the couple of years of the wellness program. I don't know that I would just kind of jump into a 50% penalty on smokers year one, but it will depend, of course, on the employer's demographic and how aggressive they'd like to be.
Okay. On the out-of-pocket limits, I know we've talked about that in the past, so there's really nothing new there. I think the one thing that we're seeing from a lot of clients, especially on our self-insured clients, is where now the deductibles and the co-insurance and the co-pays apply to the out-of-pocket. So a lot of clients are now increasing their maximum out-of-pocket, from that standpoint.
Yep.
And that's affected maybe an above-average increase also on the fully insured side. The other rules, again, in 2014, for groups that are under 100, deductibles cannot exceed $2,000 and $4,000, and the exception for plans that cannot meet the stated actuarial value. Let's see, small group, I think we'll sort of go through that in the sense of how the rating is from that standpoint. I think the bottom line for a lot of folks on the phone is that next year for groups under 50 and groups that are 50 to 99 is the carriers are changing the way they rate having to do the rates, and so that's why you've been getting bombarded with emails from SIG and phone calls saying that if you want to renew early or whether it makes sense to renew early, because the feeling is that next year the rates are going to be going up above average because of how some of this rating applies. I know in the Maryland Exchange, which is under 50 employees, the rates are going to be based on the individual age of each person, the age of the 2 oldest children, and whether, for some carriers, whether somebody's a smoker or non-smoker. So that's why we're seeing a lot of confusion and disruption as we get into next year. Anything that you want to comment on this slide or that you've talked to clients about, Stacy?
No, I think you covered it.
Okay. The individual penalty, again, everybody has to have health insurance, otherwise they're going to pay a penalty. In 2014, it's the greater of $95 or 1% of household income. Stacy, I did see an interesting post on Facebook from somebody that I know who said they had gone on the exchange and they'd gone through, enrolling, and then they did not enroll in an option, and later on they got an email that reminded them that if they did not have coverage, they were going to pay, and it was a much larger number. And somebody said, well, that could be because depending on their income, they could have a penalty that's a lot higher than $95.
Yeah, that's right. Like you say in the slide, it's the greater of these two penalties. And frankly, if you're making over, I think the way it works out with the standard deductions and this and that, if you're making over about $15,000, you're subject to this penalty. It will generally be based on your household income and not that flat dollar amount.
Right. Now, one of the questions we have from a lot of our clients is, so what? I mean, if my employee doesn't have health insurance, because we have clients that have 250 employees with only 60 people covered, let's say a lot are either Spanish-speaking and don't take health insurance or because the cost is high. The question is where are they going to get the $95 from? And right now there's not any criminal penalty or anything where somebody's going to get thrown in jail if they don't pay the $95. Is it more that if somebody eventually is owed a tax refund, they could eventually be able to track and automatically take it out of the tax refund? Or do you have any
I think
comments on that?
The only mechanism for enforcing this is to withhold the future tax refund. Like you said, they can't seize your personal property. They can't put a lien on your house. They can't throw you in jail. They can really just withhold the future refund.
Okay. Okay. Now, everybody on the phone has probably, and everybody listening to the recording has probably made sure they've sent out their marketplace exchange notice. We had communicated to everybody what needed to be done, and the fact of the matter is that is that we also sent out a letter that went with the exchange notice for them to explain it to their employees. And again, that had to be done by October 1st. I guess the question that we just want to touch base on is because knowing some of our clients, knowing that some of our clients that might not have an HR person or might be smaller, if there was communication that came out that says if you don't send out the notice, nothing bad's going to happen. So could you comment on that?
Sure. The DOL didn't do us a ton of favors with their guidance on this exchange notice. The guidance itself was ambiguous. We had known kind of early on when we looked at the requirements that there was no statutory penalty. There's no $100 a day fine like you would get if you perhaps didn't comply with one of the other insurance mandates or the market reforms, like if you didn't offer coverage to adult children the right manner, that's a $100 a day penalty. That didn't exist for the exchange notice, and the DOL confirmed that. But just because there's no statutory penalty, it doesn't mean, obviously, and this is we would never advise our clients, that you could just ignore or disregard federal law. There's no statutory penalty for failure to send the Medicare Part D notice either, but we all still get that out, and we all advise our clients to do so. The fact that there's no penalty should give you a little bit of comfort, say if you still were trying to figure out what to put in the notice, and maybe you didn't get it out until mid-October, something like that. It should give you a little comfort in that respect. But it's not something that it's simply safe to ignore, and in the right situation, you could potentially have an ERISA issue if you fail to send the notice out, because as a sponsor of an ERISA plan, you have a duty to kind of be straightforward and forthcoming with your participants, and if there's a way for them to get coverage through another source, possibly cheaper, then you kind of have a duty to disclose that. So we think it's still obviously a best practice to send that notice out.
Okay, and then could you comment for the folks that are on the phone that, let's say, have not sent it out, or the folks that are listening to the recording, what is the best method or the required method to send it out?
So there's a few different ways to distribute it. You can mail it to the house, to the employee's house. You can distribute it hard copy. You can simply put it in the new hire materials that you give to your new hires, and then with respect to everyone who's been hired on or after October 1st, pardon me, as long as it's in a new hire packet, you'll have satisfied your obligation. And this is not an annual requirement. You just have to give it to your employees upon hire, and then once they get it at date of hire, you don't have to give it to them again each year. So I think just putting a hard copy in the new hire packet may just be the simplest way. If you qualify for distribution electronically, if you meet the DOL's standards for electronic disclosure, then you can email the exchange notice to employees as well.
And I think for those listening, I think one of the biggest surprises is going to be for your employees is many of you subsidize, their health insurance. And so somebody's paying $100 a month, $150 a month, $200 a month for individual coverage pre-tax. And when they go out on the exchange, especially once all of the exchange technology is fixed, and they're going to quote a silver plan, which is usually going to be a much higher deductible, and see that it's $450 a month, and that because they're being offered coverage that's is affordable, they're not going to qualify for a subsidy, so they'd be paying basically $450 a month with after-tax dollars, as opposed to that, whatever they're paying now with pre-tax dollars. Stacy, one of the things I think we want to just clarify for those on the phone is you have employees that say, well, can I pay for my exchange premium through my flex plan? And I think the way that that is set up now, I'm not sure that they're able to do that. So could you comment on that?
Yeah, that's right. And this was kind of clarified by the IRS and the DOL just about a month ago, September 13th. The DOL and IRS released some parallel guidance on these issues. And basically, the bottom line is, you as an employer cannot permit employees to pay for the cost of their individual health insurance policies, whether they're bought on the exchange or off the exchange, on a pre-tax basis through a cafeteria plan. There's one exception, and that's if you're a small employer and you are participating in the shop exchange, then you can pay for your employees' coverage just like you would do on a traditional group health plan, and the employees can pay pre-tax for their share of the coverage. But other than that exception for small employers using a shop plan, the IRS and DOL said that if you do reimburse premiums for individual coverage and you do it on a non-taxable basis, then you're basically going to be looking at having violated two of the market reforms, namely the annual limit requirements and the preventive care requirements, each of which has a $100 per employee per day fine attached to it. So they're pretty serious about this requirement, and it appears that if you were to violate it, it'd be $200 per employee per day potentially that you'd be looking at for a fee.
And then how about for people that have health reimbursement accounts? There was a vendor out there that was out sort of packaging the selling of of HRAs and paying for coverage. But from your standpoint, if a company has a health reimbursement account, and the employee use that money to pay for coverage to the exchange?
Yeah, it's the same kind of analysis. You essentially cannot use HRA money to pay for individual health insurance premiums.
Okay.
This was known as the defined contribution HRA approach. It's fine if you're going to do it with a group platform, but for an individual platform, you can't really do it. And there's some further rules regarding standalone HRAs that basically now require your HRA to be integrated with a major medical group health plan, one that either does or does not show or have minimum value. Different rules apply, but as you mentioned, there are still people out there promoting these kinds of arrangements. Not something you're going to see one of the more reputable agencies promoting. And frankly, if you get approached by something like this, by someone who's promoting these arrangements, just ask them to produce a tax opinion from a reputable law firm, and you'll never hear from them again.
Right, and then the one thing for folks listening is that because the penalties have been postponed to 2015, many of you next year are going to want to know what is my cost if I cancel my plan and send people to the exchange versus keep my plan. And so SIG, along with the Benefit Advisor Network, have a model that Stacy was very instrumental in helping to build, that with the right census information from you, your SIG representative can do that complete analysis and give you that review and the financial impact. So that's something that I know many of you are going to be wanting to look at more closely next year. Okay, well, let's jump into DOMA, because and as Peter did at the seminar, we sort of breezed over this, but just to give everybody a sort of short Reader's Digest version as to DOMA and what they need to be thinking about or doing if they haven't already done it.
Sure. So let me, I'll kind of give you a brief overview of the issue, and then, if there's anything that you think I should focus in on, let me know. But as everyone knows, in late June, the Supreme Court struck down Section 3 of DOMA, which is the Defense of Marriage Act, and basically, as a result, the federal government now recognizes two individuals as married as long as they were legally married in a jurisdiction that recognizes the marriage. So, it's very easy then, or it should be fairly easy for individuals who live in a state that doesn't recognize same-sex marriage to simply cross over the border into a state that does, get married there, they come home, and not for state purposes, but for federal purposes, they'll be treated as married. And so as an employer, if you're in a state that doesn't recognize same-sex marriage, but you've decided to go ahead and offer coverage to same-sex spouses anyway, then obviously you can do that, and there'll be no imputed income from a federal standpoint because they're spouses under federal law. And the question that you'll ask is, is there withholding at the state level because their state doesn't recognize the marriage? In those cases, generally there would be withholding at the state level, but if you're in a state like Massachusetts that does recognize same-sex marriage, then there's no withholding at the state or federal level in states like Massachusetts that recognize same-sex spouses. One of the questions that we often get is, okay, so did this decision just simply make same-sex marriage legal in all the states? And the answer is no. The Windsor decision doesn't make same-sex marriage legal in all the states, and nor does it convert civil unions or domestic partnerships into a marriage either. Really, Windsor just addresses the federal law treatment of same-sex marriages that are performed in a jurisdiction that recognizes the union. So generally, if you're an employer in a state that does not recognize same-sex marriage, you should generally still be able to continue excluding same-sex spouses. You should take a very close look at your plan document, because if you reference a spouse under federal law, that would have excluded same-sex couples prior to the Windsor decision, but now that would pick up and include same-sex spouses. So even if you're in a state that doesn't recognize same-sex marriage, you still want to take a close look at your plan documents and make sure that your eligibility reflects your intention in light of the Windsor decision. If you're in a state like Massachusetts that does recognize same-sex marriage and you're fully insured, you're generally going to have to offer same-sex spouses coverage. If you're self-insured and you're in a state that recognizes same-sex marriage, it's not as clear that you can rely on ERISA preemption. The law can be considered a law of general applicability that calls for the recognition of same-sex marriage, and we think in those cases it would probably make sense to consult with counsel, and we can talk you through the risks of potentially not offering coverage to same-sex spouses in that situation. It's just more difficult in a state that recognizes the marriage for you to exclude the same-sex spouse even under a self-insured plan. It should generally be permissible for now, but it's not to say that there wouldn't be any exposure to a discrimination lawsuit under state law. So just be sure to think those issues through, and if you have questions, to talk them over with Richard and his team.
And I think that's the bottom line. Is our team's been in touch with many of our clients, and so if anybody does have any questions or needs to get into a little more detail on it, feel free to follow up with us, and we can we can answer all your questions. Okay, so the next thing that we've already talked about, the subsidies and premium credits and Medicaid and who qualifies for what, but I think one of the things that has come up right now is that most of our clients offer affordable coverage. Most of our clients, pretty much all of our clients know what they need to do to comply with healthcare reform for the most part, and are concerned about having affordable coverage, 9.5% of a deduction, with W-2. I think the one thing that has come up that, and most of our clients want to continue to offer benefits. They want to sort of wait and see what happens with the exchanges, and maybe some of our smaller clients may at some point decide to drop coverage because they don't have to pay a penalty. I think one of the things that is important for those on the phone, and we've had several situations of this, is that where somebody that is lower paid, that let's say has a bunch of dependents, could qualify for Medicaid because basically there's been an expansion of Medicaid. And an example of that is we have a client that has a large claimant with an $800,000 claim, and we talked about this, and now this employee that has this premature baby is now going to go, probably qualify for Medicaid, and that would not trigger a penalty in 2015. So right now, Stacy, the thing that people need to know about is that if somebody goes to the exchange and doesn't have any coverage, and depending on their income, they can qualify for a subsidy, correct? Depending on their income, if they don't have any group insurance.
Yeah.
And if somebody has group insurance, that is affordable, then they're not going to get a subsidy on the exchange unless they had affordable coverage and they were really, qualify for Medicaid. Could you talk about that?
Sure. So generally, you're not going to be eligible for a subsidy if you're offered affordable coverage or if you're eligible for Medicaid. Basically, Medicaid cuts you off the subsidy because you qualify for Medicaid under the state law, and Medicaid will generally picks up 100% of the cost of coverage. Some states and some state laws will enable people who are eligible for Medicaid to get some Medicaid funding to keep them on the employer's plan, but that kind of depends on state law. But yeah, the general principle there is if your income is below 100 or 133% of the FPL, depending on where the state is from a Medicaid expansion standpoint, people under that income threshold will be eligible for Medicaid, and everyone else whose income doesn't exceed 400% of the FPL, if you aren't eligible for a subsidy or eligible for an employer plan, would be eligible for a subsidy.
Right. And so right now, I think the thing is most of our clients have group coverage, but I guess the takeaway is that if you have some employees that are very low paid and that maybe also have dependents, they may be able to take advantage of Medicaid or some other coverage that could be cheaper than being on the employer plan, and that in the future will not trigger that $3,000 penalty.
That's right, because like you said, I mean, the fact that when you're eligible for Medicaid, you're not eligible for a subsidy, and receipt of that subsidy is what triggers a penalty on the employer. So an employee on Medicaid could not trigger a penalty on the employer.
Right. Okay. So we're not going to spend too much more time on this because it really doesn't apply to many of our clients, and we've covered this at the last several webinars and seminars. And so if anybody has any questions on that, feel free to contact your SIG representative. The next thing that we just want to let people know is that we have engaged with a company called Jellyvision, where we're going to be able to roll out to you at a nominal cost some technology that is going to be very interactive, that's going to allow your employees to be able to learn about how healthcare reform works, sort of a basic 7-minute video, and that is going to give them the information as to the specific exchange that they could qualify for depending on where they live. So this is going to be a great tool for those that have people that are out of state, that could have some lower income folks that could qualify for the subsidy, and so you'll be hearing more about that over the next 30 days from us at SIG. The next thing, in the time that we have, we're going to sort of wrap up a few highlights of some information. The next thing is we just want to cover is the UPS decision. I think the big thing on the UPS decision is that they basically said that if employee spouses have access to other coverage, they cannot be enrolled in our plan. They don't even have access to coverage. And so we've had conversations with many of you about this, and many of you have said we're not UPS, but this is a trend that we're seeing with larger employers. So again, when UPS or a big company does something, it makes others more likely to consider doing it. I think the stats were that this past year only 3% of employers basically did not allow spouses to be on the employer plan. Next year, it's projected that 35% of large employers will be doing that. Stacy, have you had much discussion with any of your clients? I would think that they might be discussing it, but not a lot of people are actually eliminating spouses from having the ability to be on the plan if they have other coverage. Could you talk about any of your experience?
Being discussed. by small and large clients. Certainly in light of this UPS decision, gained a little bit of attention, and I think it is somewhat of a slippery slope. Once there's a critical mass of companies doing this, I think this kind of, to me, it seems like it has the potential to catch on, and not eliminating spousal coverage altogether, but perhaps a spousal surcharge if they have coverage available elsewhere, or a little more aggressive would be the spousal carve-out. And you just need to make sure that if you're fully insured, state insurance law doesn't bar you from doing it, but generally, it's permissible. It could result in some employee relation issues. Obviously, I think employees prefer to be on the same plan with their spouse, but from a cost-saving standpoint, it's certainly something I think worth at least discussing. So.
And we have some self-funded employers that, for whatever reason, we're seeing some really above-average increases with some large claimants. So somebody was budgeting 6 or 8%. Now they're getting a 16% increase, and they're looking at, do I increase the deductible for every employee? Do I cut the benefits for every employee? Do I increase the deductions for every employee? Or is this something that I should consider? And most employers are not doing what UPS is doing. What they're doing is they're sloping the increase to people with dependent coverage. So if I'm going up 5 or 6% on the employee, I might go up 10 to 15% on the dependent. So they're choosing to have more of a hit towards the people with dependent coverage, which might make people more likely to consider their employer, their spouse's employer plan for the spouse. But I think this is something that we'll sort of watch over the next year, and by this time next year, we might hear that a lot more large employers may have done that. And again, there's a great 19-page Q&A that UPS put together that I think our office has sent out to many of our clients. If anybody wants to see it and hasn't seen it, feel free to contact your SIG representative. But it was a very well-written piece, and we're taking pieces of that 19-page Q&A and using that for some of our clients that are doing their own Q&A for open enrollment coming up. We're running out of time, so I just want to touch real quick on private exchanges. You're going to be hearing a lot about this. Many large employers have sent their retirees to private exchanges. You heard about Walgreens moving their 130,000 employees to a private exchange. It's basically sort of a same thing as a public exchange, but doing it where companies are basically buying their health insurance like they're doing now on sort of on an online marketplace that allows employees to have multiple options. For folks on the phone that are over 50 employees, SIG is one of 17 firms of the Mid-Atlantic that is appointed to do business with United and Liaison that has an exchange product. So over the next several months, as you have groups renewing, you're going to be seeing another option in the spreadsheet, which is this exchange option. Very embryonic, lots of initial concerns and issues, but I think over the next year you'll be hearing and seeing more of this. What you're going to see on the slide here is that they're basically saying, Accenture saying is only 1 million people are going to be enrolled next year, but by 2018 there could be 40 million people enrolled through these private exchanges. So the Benefit Advisor Network, along with SIG, has access to multiple exchanges. Aetna's come out with their own private exchange, Cigna, United, and then there are some other resources available. So just keep that in mind. In the essence of time, I'm going to skip ahead to the Maryland Health Exchange that's out there. Just to let you all know that it's up and running. Maryland is very progressive, and your SIG representative has information for you if you have any questions on that. We're including the Kaiser benchmarking information for you. Again, we're going to skip through that in the time, but please review that at when you do have time, and you can see a lot of good information here that your SIG representative can help you decipher. And then the last thing I want to just cover, because we are running out of time, is that if you want to access all the material that was on the at the SIG Healthcare Reform Seminar that Peter Maratha spoke at, you go to the www.silbs.com website, go to our website, and you can click on under the latest. You can click on the 2013 Healthcare Reform Seminar information that was in September, put in the password, and then you can download all the information. The last thing you want to do is clog up your email address, and many of you have servers that don't allow for that volume of information to get through. So that's some information, good information for you to access. Stay tuned. We are going to continue to offer webinars, and next year we're going to be offering more smaller client-specific seminars. We're hoping to offer seminars for fully insured clients, self-funded clients, small group clients that are very specific, and so we're in the process of planning that now. If you have any requests or information that you want us to take under consideration, please let us know. And again, stay tuned for the October 16th seminar. That's going to be on annual disclosure requirements. And then November 20th, we're going to have a webinar that many of the fully insured clients are going to want to participate in, which is Understanding Captives. So I know we've run through the time that we have. Stacy, I just want to thank you again for being available, for participating. Our clients really enjoy getting information in this format. For those that are listening to the recording, thanks for participating. And if you have any questions, feel free to contact your SIG representative. And have a great rest of your day. So thanks again, Stacy, and we'll talk to you next time.
Thanks, Richard. Have a great afternoon, everyone.
Take care. Bye.